Welcome to Yemreg Forex Academy. If you've always wanted to learn Forex and you don't know where to start from, you are in the right place. And in today's lesson, I'm going to be explaining Forex from the absolute beginning. By the end of this video, you are going to understand what is Forex, what is traded in Forex, and some of the common terms used in Forex, and the foundation you need before learning some advanced concepts such as market structure, liquidity, support and resistance, supply and demand, and the rest. So make sure you watch this video today. So let's get straight into the class. So here are the list of what you are going to be learning in this class. What is Forex, who participates in the Forex market, lot size and the rest, and the list of others. So now let's start with what is Forex. Forex simply means foreign exchange of foreign currency. So it just is a global marketplace where one currency is exchanged for another. For example, let's say you are based in Nigeria and you want to travel to America. Before you can perform any exchange, or before you can perform any financial transactions in the US, you need to convert your Nigerian naira to the US dollar. So by doing this, you've automatically performed foreign exchange. So that is why it is very important to understand this. So now moving on, we have who participates in the Forex market. Here are the list of people who participate in the Forex market. We have central banks, commercial banks, governments, hedge funds, companies, retail traders like me and you. And one thing that most beginner traders think is that they think retail traders control the market, but that is not true. We don't. So the biggest participants are mostly central banks, commercial banks, governments, and the rest. Those are the real market players or the market movers, right? So it is very important to understand this. So what we do as retail traders is that we simply analyze the movements created by these large participants. We try to trade alongside them. So we use platform like TradingView to analyze the market, to know the direction in which the market is heading, when to buy and when to sell. So that is the work of elite traders, right? And the other part of the participants, who is like the opposite of retail traders, are hedge funds. Hedge funds are mostly like a group of individuals that trade with large sum of capital. Unlike retail traders, we trade with small capital. So those are the market participants. You can also call them market players. So moving on to the next topic, which is why does Forex exist? Many traders does ask these questions, especially beginner traders. Why does the word Forex exist? So Forex exists for various reasons, and one of them is to travel, import and export goods. Without exchange, without foreign exchange, you can't import and export some goods. To study abroad, to invest internationally, to trade for profit, which we are going to be doing in Forex trading. So we are literally here to trade for profit. So Forex exists because country use different currency, like different country with different currency. For example, Nigeria, we use NGN. That is our currency, Nigerian naira. So Nigeria importing goods from China, they cannot pay with naira. It is not possible. You need to pay with their currency. So you need Chinese yuan or another accepted currency in the country before buying or doing anything with them. Same thing with investors buying US stocks. They need US dollar before they can buy stocks. Same thing with travelers. Before visiting another country, they need the country currency. They need to exchange the currency in their country to the country currency, the country they are visiting, before they can perform any foreign exchange. So that is why exchange is very, very important, right? So moving on, we have why is Forex popular? Forex is popular because it's a 24 hours a day market. It has high liquidity. It is accessible worldwide. Starts with relatively small capital. Trade rising and falling market. So you can literally trade from the rising and falling markets, right? So Forex is popular because it is everywhere. We can trade it from the comfort of your home. So that is it. So moving on, we have those who move the market. What move the market rather? So on what move the market, here are the list of things that move the market. We have interest rates, we have inflations, employment data, central banks, policy, and the rest, economic news. So these are the list of things that move the market. Without all these other things, the markets won't move, right? So moving on, we have what is a currency pair. Now, in the first market, you can't, before you can make any exchange, you need to what? You need the other currency. So it's not possible to make an exchange with a single currency, right? So you need to pair the two currencies together to make an exchange. And here are the list of examples of currency pair we have in the Forex market. We have Euro USD, GBP USD, USD JPY, AUD USD, and the rest, right? So now, before you can buy any single currency by itself, you always want to trade one against another. That is why Forex instrument is called a currency currency pair. So the first currency is compared with the second currency to determine its value. For example, euro is compared to USD to know the value. Same thing with the rest that are here. So that is that on that. So let's move on to the next on the list. So we have the first currency and the second currency. In a currency pair, the first currency is called the base currency. For example, here we have euro. Euro is the base currency, while USD is what? Quote or counter currency. So in every currency quotation, the first currency is known as the base currency, right? So it is known as the base currency, while the second currency is known as the what? The counter currency. As we can see on the screen, we have base currency, which is the euro. We have USD, which is the quote currency, or you can also call it what? The counter currency. And this shows how many US dollar are needed to buy 1 euro. That is what it's telling you, like how many USD you need to buy to purchase 1 euro. And this is an example. Let's say euro USD is 1.0825. So what does that mean? It means that what? 1.0825 US dollar is needed to purchase 1 euro. So that is what it's trying to tell you. This is more like the exchange price of that particular currency, right? So now moving on, we have the quote currency explained here on the chart. Same thing. No, the only difference is that the quote currency is the second currency in the currency quotation. So that is that on that. So moving on, we have how this currency pair works. Now, for example, if like this is the exchange rate for euro USD, we have 1.1500, right? So if price rises to 1.1600, what does that tell you? That tells you that what? Euro has gained value. So whenever you see the market moving to the upside, to the up direction, it means that what? The base currency is gaining value. And whenever the market is dropping to the downside, it means the quote currency is gaining value. So what does that do to the base currency? Automatically the base currency will start losing value. The base currency will be weakened. That is what we are having here. So if the price is the same as 1.1500, the euro is unchanged relative to the dollar, right? Same thing goes for this. If the price falls to 1.1400, the euro has weakened, right? So the fact that the euro has weakened, the dollar is strengthened. So whenever you see the price going to the upside, the base currency is strengthened. Whenever the price is dropping to the downside, the quote currency is being strengthened while the base currency is being weakened. So that is just how it is. So the exchange rate shows how much of the quote currency is needed to buy 1 unit of the base currency. That is what it means in a nutshell. So moving on, we have the types of currency pair. We have different types of currency pair in the forex market. We have the major currency pair, we have the minor currency pair, we have the exotic currency pair. So a major currency pair includes the US dollar, while the minor currency pair do not include the US dollar. For the exotic, 1 major plus 1 emerging currency, right? As a beginner forex trader, your primary focus should be the major currency pair, and I'm going to explain in the next slide. So moving on, we have the major currency pair. So these are the most traded currency pair in the market. The major currency pair, these are the most traded. We have Euro USD, we have GBP USD, USD JPY, USD CHF, NZD USD, AUD USD, USD CAD. These are the most traded. It is more than this though. These are the list I have here. So these are called major pair, just like I said earlier, because they include what? USD. USD is included in the quotation, and they are among the most traded pairs in the world. They generally have tighter spreads, greater liquidity, and more predictable price movements, making them a good starting point for beginners. Don't forget to like and share this video and subscribe to this channel. So moving on, we have exotic currency pairs, and here are examples of exotic currency pair. We have the US3RY, we have the USD ZAR, that is South African rand, we have the USD MSN, and the rest, right? So now what does exotic currency pair means? The exotic currency pair consists of 1 major currency and 1 currency from an emerging or developing economy, like an economy that is still traveling, that their economy is very weak. So automatically, if their economy is weak, their currency is going to be weak, right? So this pair often have wider spread, and that is why it is not recommended for a beginner trader to trade them. They have low liquidity, they have high volatility. While they can provide large price movements, they are generally not suitable for beginners because trading costs are higher and the price behavior can can be less predictable. So that is why it is very important to stay away from this exotic currency pair. And some brokers don't even offer it. So you can't trade them on some brokers. So there are the reason why you should stay away from exotic currency pair. So let's move to the next, which is minor currency pair. And here are the list of minor currency pair. We have Euro GPP, we have Euro JPY, we have GBP JPY, we have AUD NZD, Euro AUD, and the rest. Minor pairs are important and can present great trading opportunity once you gain more experience as a forex trader. So one thing you should know about minor currency pairs is that they are known as cross currency pair because they do not include the US dollar. They are made of two major currency. Although they are relatively traded, they generally have lower trading volume than major pairs, and they have slightly higher spreads than the major pairs. So as a beginner, you should understand them, but it is usually better to focus on the major pair until you gain more experience in the foreign exchange market. The next is bid and ask price. The bid price is the price at which the broker is willing to buy from you. So the bid price is the price at which you can sell a currency pair. If you are closing a buy position or closing a sell position, your order is being executed at the bid price. While for the ask price, the price at which the broker sells to you. Ask price is the price at which you buy a currency pair. So whenever you open a buy trade, you enter at the what? At the ask price, also known as the buying price. And here's an example. The first is the bid. First number is the bid, and the second number is the ask price. So if you subtract this from this, it's going to give you what we call spread. So the difference between a bid and the ask price is what is called spread. And at the end of the day, the distance or the movement between these two numbers is a pip, right? And that's why we're having 2 pips here. So like I said earlier, the difference between the ask price and the bid price is called spread, and this represents the broker's fee for facilitating the trade. So this is how your brokers make money in the market, right? And who are brokers? Forex brokers are literally financial institutions that give you access to the market. Without them, you can't have access to the market because the forex market is the largest in the world, and so you can't have direct access to it as an individual. So you need to go through an intermediary, right, which is a broker. They also call CFD provider. So they give you access to the foreign exchange market. Just see them as your banks. Like before you can perform any financial transaction, you need to have a bank account. Same thing in the forex market. Before you can trade the market, before you can trade the live market, you need to have access to a broker. So it is very important as a trader, as a beginner trader, whenever you want to start your trading journey, try as much as possible to register with a broker that has a very tight spread. The next topic is what is a pip, and this is one of the most important beginner topic every trader needs to understand, right? So a pip is a unit of measurement used to express the change in value between two currency, and is the smallest standardized movements in price. So a pip is just is a unit trader use towards mention price movement. It's usually the first number after your decimal number. So now, for example, instead of saying the price move from 1.1200 to 1.1210, trader can simply say the market move what? 10 pips. So how did we get 10 pips? You subtract this from this, is going to give you 10. The two first number at the end of this number from this, which is going to give you 10 at the end of the day. So some brokers number can be in 50 decimal places, which is usually called the pipettes, but most times brokers quote their price number in 4 decimal places. So the fourth number is usually known as the pip, right? And here are examples of how you can calculate your pip movement. Now, for example, let's say we're having Euro USD, and the price number for Euro USD is 1.1200, and the price moved from the first price to this price number, right? And remember I said pip is just the price movement, how price move from one place to another, from a point of your entry to where the current market price is at. So you usually use that to measure the pips. So now if price move from 1.1200 to 1.1201, automatically price has moved 1 pip, right? And if it's more than 1, that is going to be 2 pips. If it's more than 3, that is going to be 3 pips. And for GPP USD, same thing also goes for GPP USD. So I'm going to show you guys on the trading view how this is being how you can calculate it on your trading view. It's very simple and straightforward. So let me show you guys that. So as you can see, if you want to calculate your pips on your trading view, this is very simple and straightforward. So just come over to this toolbar and click on this mention ruler. Then click and hold on your mouse. Start from you can decide to pick any price number. And currently we are on AUD USD. So let's say we enter the market from here, from 0.68655. So then this is where the current price is. The current price is at 0.6889. So automatically price has moved from year to year. So if you are to check the pips movements, this is it here, 24 pips. So the market has literally moved 24 pips from this point to this point. So you can literally use your mention ruler to mention your pips, and you can also use other tools. For example, you want to know your stop loss or your take profits. Stop loss is when you want to be out of the market. Take profit is when your target has been reached. So you can literally use the long or the short indicator. I'm still going to explain to you guys how to use this platform in the next video I'm going to drop on this channel. So now you can, for example, go long simply means long position simply means you are buying. Short position simply means you are what, selling. So now let's say we want to long, right? So we are logging from here. So here is our price. This is our entry. We are entering from here, and our stop loss is going to be below our entry point. So let's decide, okay, we are putting our stop loss here and our target is going to be here, right? So now looking at this, your stop loss pip is 3.2, while your target pip is 23.8. So the movement from year to year is your pip. Price moved from all the way from here, move all the way from here to this place. So the distance from year to year is simply known as your pips. So there are other manual ways you can do this. You can do subtraction and addition or whatsoever. You can subtract the price number, the entry price number from the target price number to be able to get your pips calculation. Or in the next video, I'm also going to drop a detailed video on how to calculate pips and others. But you don't have to stress yourself. You can literally use your trading view tools to calculate your pips, or you can also use your MetaTrader app to calculate your pips without stressing yourself. So let's move on to the next topic on the curriculum. Moving on, we have lot size. Lot size is also one of the most important aspects in Forex Basics. And what does it mean? Lot size simply determines the volume of your trades. So the lot size tells the market how much you are buying or selling. So it directly affects how much money you make or lose for every pip the markets move. And here are examples of lot size or types of lot size. We have standard lot size, we have mini lot size, we have micro lot size, we have nano lot size. So we are going to be focused on these three. This one is not that very important, right? So for standard lot size contains 100,000 units of volume, right? And which is also known as what, 1.0 lot size. For mini lot size contains what, 10,000 units, and which is also known as 0.1 lot size. For micro lot size contains 1,000 units, which is also known as 0.01 lot size. In my next video, I'm going to be explaining this in a more detailed way on how lot size and pip works. So stay tuned. Now moving on, for every pip move of using standard lot size of 1, the price is going to be what? The result is going to be $10. What do I mean by this? Whenever you use a standardized lot size of 1 and the market move in 1 pip, that is going to be what? $10 per pip movement for a standard lot size of 1. So for a mini lot size of 0.1, it's going to be $1 per pip movement. For a 0.01 lot, it's going to be 0.10 per pip movement. That is cents. This is cents already. This is in a cent, just like kobo if you are in Nigerian, right? Lot size is very important because without lot size, it is very important to understand it and it's also very important to use the adequate lot size. So the bigger the capital you are trading with, the bigger the lot size you can use. But it's also very important you should know the right lot size to use, right, as a beginner's forex trader. So one thing you should also know is that the P values varies depending on the currency pair. and your account's currency, right? So value shows are examples based on USD account. So you can literally use any other currency of your choice, right? So this display here is based on the what USD. We are using USD as our account. So one thing you should also know is that lot size control the size of your trade, and with it the size of your potential profit or loss. So that is it on lot size. So let's move to the next on the list. What is leverage? Leverage allows you to control a larger trade with a smaller amount of money, right? So leverage is just like using borrowed buying power. For example, with with 1 ratio 100 leverage, every $1 in your trading account controls up to what $100 in the market, right? So while leverage can increase profit, it can also magnify losses. So that is why risk management is very, very important. And this is how leverage works. Your capital is equal to multiply by your leverage. This is going to give you what? Your buying power. For example, your capital is $100 and your leverage is 1:100. And remember that you can choose the leverage of your choice depending on the broker. We have 1:500, 1:1000, and some brokers offer unlimited leverage. So you can literally choose your leverage when you are signing up with your broker. So your buying power here is going to be what? $10,000. And here are examples of leverage. So let's say your leverage is 1:10 and your capital is $100. So automatically your buying power is going to be what? $1,000. So every $1 controls $10. Same thing also go for the rest of the example we are having here. So it is very important to understand this as a trader, right? So leverage is a powerful tool. Use it wisely and always manage your risk. Risk management is very, very important, right? So one thing you should also know is that leverage increases your market exposure with less capital. It can boost profit, but it can also magnify losses. So that is why it should be very, very important to manage your risk, right? And most times beginners trader over leverage. Don't do this so that you can stay in the game way longer. So it's all about consistency, it's all about being profitable. So let's move on to the next on the list. What is margin? Margin is the amount of money required to open a leverage trade. Margin is not a fee. It is a portion of your account balance that the broker temporarily set aside as a collateral while your trade remains open. And this is how margin works, right? Let's say your account balance is $1,000, your leverage use is 1:100, your trading size position is automatically going to be what? 100,000. So your required margin is going to be 1,000. So what is missing is that 1,000 of your account is set aside as a margin to keep the trade opens. So here are some of the key points. Margin allows you to control a larger position with less money up front. The more leverage you use, the less margin is required and the higher the risk. So if the trade goes against you and your margin is insufficient, you may get a margin call. And margin call happens when all your accounts start showing red. Your balance, your equity, your trading position start showing red, or your broker can close the position automatically. So sometimes for brokers to protect your capital, they will close the position automatically. And if the position are not being closed automatically, you can lose all your trading capital, which is also known as blown accounts. So that is why. So it is very important as a trader to always manage risk. And remember that margin gives opportunity, but also risk. So use proper risk management and never risk more than what you can afford to lose. So the next on the list is time frame. A time frame is a period each candlestick represents on the chart, right? We literally have different types of charts in the forex market. We have line charts, bar charts, candlesticks. Well, we are going to be using candlestick. We also have the host of others, but the commonly used one is candlesticks. And now time frames, like I said, it tells you how much time each candle represents. So for example, on the 1 minute time frame or on the 1 minute chart, every candlestick represents 1 minute of price movement. On the 1 hour chart, each candle represents 1 hour price movement. So the price is exactly the same across the time frames, only the way it is displayed on the chart or on the screen that changes, right? And here are example. This is 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, day 1, week 1, months. So you can literally customize it to any time frame of your choice. And the more time frame you go, the higher the time frame, the smaller the chart will become, right? Let's say you saw 4 candles on 1 hour time frame. So this 4 candles is going to be one candle on each 4 time frame. That is 4 hours time frame. So the 4 candles has become one. They sum up to become a one candle. Same thing also go for day one, for week one, and the rest. So here are the list. So we can go to your trading view to change your time frame. And let me show you guys on the trading view. So here is it on trading view. So these are the time frame. You can literally change your time frame from here to any time frame of your choice. And now let's say, for example, I'm currently on 30 minutes time frame. By the time I change this so let's say 1 hour, can you see the candles have sum up, they've become bigger. Let's move to the next topic, which is candlesticks. So candlesticks is graphical representation of price movement over a specific period of time. A candlestick chart is the most popular chart used by forex traders, right? Instead of showing only in a line, each candle tells a story about what happens during a specific period of time, right? So now, here are the components, or here are the list of things that a candlestick comprises of. We have the open price, we have the high price, we have the low price, we have the close price. Now we also have what we call the body. This is the body of the candle. This for starting from here to here, this is the body of the candle, and this styling line is what we call the wick or shadow, wick rejection or shadow. So this is what we call the wick. And now we have two types of candle. We have the bullish candle, we have the bearish candle. What does the bullish candle mean? The bullish candle simply means a buying candle, a candle that is moving to the up direction, while a bearish candle simply means a selling candle, a candle that is moving to the down direction. So see this as the what? The buying candle, and see this as the selling candle. And one thing you should know about this candle is that you can customize it to any color of your choice. You can change them to any color of your choice. So it really tells you the what direction, just like we are seeing here. Here now, the candle is moving to the up direction. So automatically, this is a bullish candle, or this is a bullish trend. Here, the candle is moving to the down direction. This is what? A bearish candle, and this is what? A bearish trend, right? The market is dropping to the downside. The market is moving to the upside. And this candle comprises of the body, the wick, right? And this is the high. This is the highest the candle moved to. And this is the lowest the candle moved to. This is when the candle closes, and this is when the candle opens. So this is literally used to differentiate between a bullish candle and a bearish candle, the open and the closing price. So if a candle opens from the bottom and closes at the top, that is what? A bullish candle. If a candle opens from the top and closes at the bottom, that is a bearish candle, right? So you can also read up on candlestick patterns and the rest to understand more candlesticks. So moving on to the next topic, which is trading sessions. We have 4 major trading sessions. We have the Sydney sessions, we have the Tokyo session, we have the London session, we have the New York session. And these sessions, they represent different continents. For Sydney, it represents Australia. For Tokyo, it represents Asian continent. For London, it represents European sessions. And for New York, it represents the America sessions. So the forex market operates across 4 major trading sessions. Activity shifts around the world as the financial center opens and closes. London and New York are typically the busiest sessions in the forex market, right? And one thing you should know about the trading session, this also represents your local opening and closing hours in your local country. Most companies opens within 9 a.m. or 8 a.m. in the morning, and it closes around 5 p.m., 6 p.m. depending on the country. So all these other things, depending on the company, all these other things are what contribute to the financial market, right? So, and this session talks about how active a particular currency can be. So that is why it is very important as a trader to understand how trading session works. So trading session tells you about the activeness, the time the market is very, very active. Like I mostly trade GBP USD and Euro USD, and these currency pairs are active during London and New York section, right? And it is very important to always trade according to your trading sessions in order to trade with a tighter spread, because when you are trading against your trading session, let's say for example you decided to trade GBP USD during Tokyo section, there's going to be high spread by your broker, high trading cost by your broker, and the market is likely going to be moving slowly. And this is going to definitely affect what we call trading psychology. In my next video, I'm going to talk on trading psychology. So it is very important to always trade according to your trading sections, and each of these trade sections represent a particular currency. For example, euro and GBP is one of these currency in this in London session. In New York session, we have the USD, US dollar. In Tokyo, we have Japanese yen. In Sydney, we have what's it called, AUD, Australian dollar. So it is very important to know the currency to trade during these sessions, and these sessions opens and closes at this time mentioned here, and you should also be able to convert this time zone to your country time zone. Like me now, I'm based in Nigeria. New York session in Nigeria is 1 p.m. West African time, while London session is 8 a.m. West African time. So you can literally convert this to your country time zone, right? So that on trading section. So let's move to the next on the list. So we have trading platform. Here are the major trading platform, or the ones I use personally. So trading platform allows you to analyze charts and execute trades. TradingView is excellent for chart analysis, and here is TradingView. While MetaTrader 4 and 5 are widely used for placing and managing trades. So this is what I use this platform for. So MetaTrader 5 is just the updated version of MetaTrader 4. So I mostly use MetaTrader 5 to place trades, and I use TradingView to analyze the chart. So in my next video, I'm going to be dropping a detailed explanation on how to navigate through these two platforms. So let's move on to the next on the list. So we have types of analysis. Here are the three major types of analysis. We have the technical analysis, the fundamental, and the sentiment. So one thing you should know that every successful traders combine these three forms of analysis to be able to know the bias of the market, to know when to buy and when to sell in the market. And one thing you should know that is technical focuses on the chart. It tells you about price actions, price movement, and all that. You use it to study price movement. For fundamental focuses on economic news or economic data. And for the sentiment analysis, consider overall market psychology, right? So these three analyses are very, very important as a trader. Do not ignore any one of them, right? And most times, one of the common beginner mistake is that they focus majorly on technical, which is very bad. They ignore fundamental and they ignore sentiment. So try as much as possible to focus on these three things before executing that trade. So that is that. So let's move on. So this is how trader makes money. And one of the biggest advantages of Forex is that you can profit from the rising and the falling of the market, right? So whenever the market is going up, you buy, and that is what we call buy low. So now, whenever the market is dropping to the downside, you sell, and that is what we call sell high. So you buy from the bottom, you sell at the top, right? So you sell high, you buy low. You buy low, you sell high. So whenever the market is up and dropping is moving to the opposite direction, you buy. So buy long, and you sell short. So if you believe that price is going to rise, you buy. If you believe that price is going to drop or fall, you sell. So this is how traders make money. They make money from the rising and falling of the market. So that is that on that. So let's move on. So here are the common beginner mistakes that I will advise you to avoid as a forex trader. So one of them is over trading, over leveraging, no stop loss, revenge trading, chasing signals, ignoring a trading plan. So all these are the common beginners mistakes you should try as much as possible to avoid as a forex trader. So please try to avoid these mistakes in order to stay profitable. Your goal is to become a long-term profitable trader, not just to make profits once and you are off the market. No. So that is it. So it is very important to know this as a beginner forex trader. So here are the roadmap for you to become a profitable trader. We have the Forex Basics, which is what I'm discussing in this class. We have technical analysis, which is I'm going to talk more on. I'm going to release videos on this as well. I'm going to release video on all these whole things that are here. So we have market structure, liquidity, fundamental analysis, risk management, trading psychology, backtesting, and the rest of the host of others. So this is your learning roadmap. It's more than this, though, but this is just in surface of it, right? So in order to become a profitable trader, remember you need to practice. While watching this video, try as much as possible to write out things that are being said in this video. Try to jot them down in your diary or in your jotter whatsoever, so that you can go over them as a reference point, because some of them you must have forgotten them. So try as much as possible to do this. And remember that forex trading it requires adequate learning. So that is it. So if you haven't subscribed to this channel, make sure you subscribe, like, comment, and share. See you guys on the next one. Bye for now.